Right now we're seeing red across the board. The Dow down about 1.25%. The S&P down just about the same. The NASDAQ composite down just 1%, still on pace for a 4% gain this week. The 10-year note at 3.406, about 50 basis points lower than it opened just last Friday. Of course, we know all the issues in the financial sector we've had since then. And today we're looking at the banks. They are lower across the board again today. We're looking at the KRE and the XLF. Both of them are lower, capping off a really chaotic week for the financials. The focus now turns to the next week as we gear up for an increasingly critical Fed decision on Wednesday. So given today's pullback, how should investors be positioned heading into next week? Let's get this conversation started. Joe, I'm going to turn over to you first. We're seeing the pullback today. We're going to get to some data about inflows into cash out of equities. But in general, what are you seeing? What are you thinking?
Well, it's a disinflation formation again today. So you have a 2-year back below 4%. Commodities once again are leading on the downside. It's the Russell of the three major indexes where you're seeing the most loss of value. The Nasdaq's trying to find a degree of support. It's one of the better indexes on the day. So you have not been able to wash away this disinflationary element as a result of SVB and the events of last week. Clearly, it has cracked confidence. That is without question. We've seen this week the consensus capitulation where the reality is nobody's making money this year. You know, the formation was long physical commodities, short bonds, long financials, long energy, long healthcare. None of that is working. Underweight towards mega caps and technology itself. It's a very difficult environment. Frank, I think ultimately what that leads to is less liquidity in the market. Because the tendency now for those that are losing money is to pull back and not participate until you get further clarity. Now you combine less liquidity with a higher volatility environment and a triple witching Friday, and that makes for an ugly looking tape.
Joe, it sounds like you've been talking to Steve Weiss. He's been saying a lot of similar things. Steve, what are you seeing today? I mean, we're seeing the NASDAQ, the best performer, quote unquote, down 1%.
You know, at some point, there's some debate, but look, you're wearing a blue suit. There's no debate to that, right? But we can debate whether it's tight around the middle or not. You know, that's a legit debate, but we can't debate the color. So my point is the following. You can't debate the markets going down. We're at the tip of the spear, as I said the other day, on what the Fed tightening policy is doing. This is just the first indication. In order to buy the market here or buy stocks in the market, you have to believe that this is the final event, but it's not. It's just the beginning of what you're going to see in an economy that's continuing to decline. So why would you buy stocks? If the economy is declining, earnings are declining, that means valuation's too high. And the move into tech, that's a temporary move. So there are people that have to be in the market. Some of them are on the show. They got to be in the market. They're not the asset allocators. It's not their fault. So they're looking for the best place to go, the most defensive place to go. And maybe that's big tech, because you don't have balance sheet concerns. You don't have lending concerns in terms of rates. So, but you will have growth concerns. So the phenomena we're seeing now, we'll get to what we talked about FedEx, is if you cut heads, that's great. Your stock's going up. So even though you're missing a revenue line, even though you're missing an earnings line, you cut heads, well, then you're going up. Guess what? You can't cut to zero because the growth slows. So I would not be buying anything in the market at all. Just go to cash. There's some days to play, some days to preserve capital. Preserve capital.
You know, Steve Weiss, you're not the only person thinking that. Also, I'm going to hit the abs harder in the gym. I feel like that was like a shot. I don't even know. Brenda.
The show still has 56 minutes.
Yeah, we got
to get started early. I know you like the repartee.
Seriously, when I get out of here, right to LA Fitness. Anyway, Brenda, what are you looking at right now? Obviously, you have a lot of exposure to what's going on in the West Coast and the banks and Silicon Valley. Are there any places you can look for opportunity?
Sure. I mean, I think we're in a stock picker's market, maybe not today, but I still think there are opportunities out there. And I think for people that want to have some diversification, having some bonds in your portfolio doesn't hurt either. You know, that's an area that we added a little bit to right at the end of last year at the expense of large cap equity. So I think that there is still a decent risk reward on the bond side. But I think there are still opportunities in the stock market. And particularly, I think we need to wait and see what happens next week. If the Fed pauses, even if it's temporarily, I think that could, cause money to flow back onto the equity side. But I do think the recent events of the past couple of weeks are effectively doing the Fed's job for it. I do think that the economy is likely to slow as a result. if not for less lending, but also just especially in my area where I live in Silicon Valley, I think just when you look at consumer confidence and what's happened with the recent events, there's reason to believe that we may see a pullback in consumption as a result.